Hey traders, Mike Sir here. From profiling so many hedge fund managers in my past videos, I've gotten to know their trading style, their trading strategies, and exactly how they make money. More importantly, I've had the opportunity to analyze and implement some of their strategies in the way that I manage my own personal portfolio. So in this video, I'm going to share with you the ways that fund managers manage money for their investors and how you can learn from them. Now, please keep in mind that this is not financial advice, so please consult your financial advisor before making financial decisions. So let's get started. When you set out on a path to become a fund manager or even just a trader, you must decide what asset class that you want to specialize in, whether it's stocks, commodities, currencies, or even cryptocurrencies. Now, the reason is determining the asset focus for a fund manager involves a combination of factors that revolve around the objective of the fund, the type of investment strategy you want to deploy, the risk tolerance, and the type of investors that you want to target. So the first thing that you need to do is define the fund's investment objectives. Are you aiming for long-term growth where you're looking to provide a steady growing return to your investors? If so, you may choose to focus on buying profitable and growing large cap companies such as Apple that's made over $100 billion in profits in 2022 and also still growing their revenues. Or you could focus on equity indices such as the S&P 500, which reflects the overall performance of the US stock market. And you can see from this chart that over the long term, it has steadily gone up over time. And in fact, the 10-year performance is astonishing 300%. Now, another option is if your investors are looking for monthly or quarterly income to supplement their earnings, then you may want to focus on dividend-paying companies such as IBM, which pays a current yearly dividend of 4.7% and has a 100+ year track record of dividend payments. Or you can consider income producing instruments such as REITs, which stand for real estate investment trusts, such as Realty Income, which invests in commercial real estate and pays a monthly payout of 0.45%, which equates to over 5% per year. Or it could be just capital preservation, where you can buy safe fixed income investments such as the US 10-year government bond, which has a 4% annual yield, or simply cash equivalents such as US Treasuries, which have yields between 4 to 5% depending on the holding period. Now, these investments are relatively safe because they are backed by the US government. Or you can invest in stronger currencies such as the US dollar relative to other currencies. And this is a chart of the US dollar versus the Japanese yen. And you can see over the past 10 years, the US dollar has always shown strength as the stronger currency relative to the yen. And lastly, if you're aiming for high risk but highly speculative returns for your investors who are comfortable with risk, then you could focus on small cap stocks that could potentially skyrocket in price, or in the cyclical commodity markets like crude oil, or dabble in the volatile cryptocurrency market. Now, all these objectives will influence the type of assets that you as the fund manager should focus on. Next, once you've chosen the asset class to focus on, you want to employ the best type of trading strategies to generate returns for your investors. Now, there's so many strategies and approaches, but before I share with you the fund management strategies, I want to let you know that this video is sponsored by Darwin X0. This is the new exclusive service powered by the people behind Darwin X, an FCA-regulated asset management company since 2012, where you can build your trading career without putting your capital at risk. They are a one-stop solution to helping you build your own track record, perfecting your strategy, and attracting capital. They offer monthly capital allocation from Darwin X up to $500,000 and unlimited third-party investor capital. Zero restrictions and limitations to your trading, and most importantly, zero money risk to you. Now, how does it work? Only a €95 sign-up fee and €38 per month. Click on the link in the description box below and get a €20 discount for the first 20 people. So let me share with you 4 types of fund management strategies. The first type is for fund managers who look at the financial markets from a global macro and big picture point of view. Now, this type of approach focuses on making trading decisions based on the macroeconomic factors such as GDP, inflation, and interest rates. It will also include identifying geopolitical events such as war and conflicts amongst countries, as well as look at the broad market trends that have the potential to impact various asset classes on a global scale. Now, you wouldn't be trading in individual stocks, but rather in various asset classes, including currencies, commodities, fixed income, and equity indices. Now, the primary goal of a global macro strategy is to capitalize on the direction of entire markets or economies to generate returns for your investors. The second type of fund management strategy involves picking individual stocks based on their company fundamentals and where you would employ a value investing or growth investing approach. Now, a value investing approach would involve buying company stocks that are believed to be undervalued or trading at prices below their intrinsic value based on their financial statements, earnings potential, and other relevant financial metrics. Now, the goal of value investing is to buy these undervalued companies with the expectation that their prices will eventually rise to reflect their true worth, generate capital appreciation for your investors. For hedge funds, they employ a long-short equity approach where they aim to buy undervalued stocks while looking to short overvalued stocks. Now, a growth approach would be buying company stocks that are expected to experience above average growth in terms of revenues, earnings, or other key performance indicators. Now, the primary goal of growth investing is to generate capital appreciation by investing in companies that are poised to expand quickly and outperform the broader market. The third type of fund management strategy is to employ a momentum, technical-driven approach where a company or economic fundamentals don't matter as much. And this type of approach involves utilizing technical analysis and looking at charts to identify potential trading opportunities based on market sentiment, price trends, and reversals. You would be utilizing technical indicators such as the RSI to identify overbought or oversold conditions to look for reversals, or MACD to determine the price momentum. Now, typically, this is a shorter term management approach as you simply buy and keep holding the assets that exhibit strong price performance and then sell the assets when they show weak price performance. The fourth approach is to specialize in a specific sector where all your investments are concentrated within an individual industry, such as technology, energy, precious metals, or healthcare. And the goal of this strategy is to capitalize on trends within the sector. Now, if your chosen sector experiences robust growth, you may achieve higher returns compared to the overall market. As well, sector strategy investing can provide opportunities for you to take advantage of specialized knowledge, insights, and convictions about certain industries. However, it's crucial to remember that sector performance can be volatile and that diversification across multiple sectors or industries is important for risk management. Now that we talked about so many different strategies, let's focus on the most important job of a fund manager, and that is risk management. Now, as mentioned, you as a fund manager should always consider the risk tolerance of your fund's investors. Now, some may prefer more conservative investments, while others might be willing to take on higher levels of risk for potentially higher returns. Your goal is to generate positive returns, but more importantly, it's to not lose your investors' capital. So let me share with you 4 risk management strategies that can help you mitigate various types of risk. Now, the first strategy is diversification. Now, diversifying your portfolio by spreading investments across different asset classes, sectors, and even geographical regions can reduce the impact of a poor performing asset in your overall portfolio. Basically, you don't want to put all your eggs in one basket. The second is using stop loss orders. Now, no matter how much you feel a stock or sector is undervalued, if the price falls to a specific level or reaches a maximum risk level in your overall portfolio, it's time to sell your positions to preserve your capital. Now, you don't want a specific losing trade to drag down your entire portfolio performance. The third is hedging. Now, rather than exit losing positions, most hedge fund managers use hedging strategies such as options, futures, and derivatives to protect against the downside in their portfolio or specific risks like currency fluctuations or interest rate changes. Now, this allows you to manage the volatility of your portfolio during turbulent times. The fourth is risk assessment and measurement. Now, fund managers use risk assessment tools and metrics to quantify and measure the potential risk associated with their portfolios. For example, Darwin X Zero, the sponsor of this video, looks at several risk metrics whether to fund a manager. One is the manager's maximum positive or negative excursion per position. Now, this measures the maximum amount of profit or loss experienced by a trade from its entry point to its maximum profit or loss point before the trade finally turns in favor of your position or is closed. So basically it tells you how well the fund manager manages profits and losses. Another metric is duration versus profit or loss. And this looks at how long a fund manager holds on to winning trades and losing trades before they exit. And lastly, value at risk. Now this metric quantifies the maximum potential loss that an investment might suffer under normal market conditions. Thanks for watching. Please hit that like and subscribe button and let me know in the comments section below if you want more videos on how to become a fund manager. I'll see you all in the next video.